Hey everyone, me Kevin here. Welcome back to another, market status report and why stocks are all of a sudden jumping. Let's go through everything, including the retail sales numbers, Walmart, Affirm, Home Depot earnings, some highlights from these, and some other notes, including this one that I want to start with. Lux Capital, a venture capital firm, is telling their companies that they've invested in that the world is falling apart, and I've lost my voice a little bit, that the world is falling apart, and that venture or that companies they've invested in need to act accordingly, no longer expecting higher valuations, potentially raising at lower valuations, and expect job losses coming in. They say that 2020's COVID disaster and that short recession was really a false alarm because we had low rates and high spending, and obviously the market boomed after that. And ultimately their takeaway is, and this is an important one, I think, for all of us to always think about. Companies don't die because their product sucks. They die when they run out of money. I think that's honestly true of people as well. It's like if we are investors, don't fail because we made a mistake. We fail because we ran out of money. But anyway, we're hearing more and more in the VC space a lot of this fear and angst. I'm at a VC conference. A lot of people were complaining, suggesting, oh yeah, it's harder to raise money. This is why people should be raising money for like recessionary things, which it's kind of like if you go to metkevin.com/Series A, that'd be really a good opportunity. But anyway, you're hearing a lot of this talk about, oh no, we're already in a recession. It's a lot of kind of doom and gloom. For me, I think it's the buying opportunity of a lifetime. I'm going to look back in 5 years and go, dang, I'm so glad I picked up as many shares as I did. But anyway, this was interesting because it stood out a little bit of a contrast to sort of this venture capital sentiment. I think these people can be quite emotional, just like people in general. Analysts at JP Morgan Chase, quote, reckon that global capital expenditures, so basically investments into businesses, rose by 7.6% in the first quarter compared with the year before. So that's quite substantial, and twice the rate towards the end of 2021. So in other words, you're getting a lot of this mixed messaging, right? You're getting this messaging of some people having substantial fear, but then some numbers still coming in actually decent or not so terrible. And I think this is actually one of the things that creates so much pain in our markets right now, is we're like, why? Why is it so unclear? Like, for example, we got the Empire Manufacturing Survey. It wasn't that great. That was, we missed on numbers, and the numbers are too hot out here. It's ridiculous. The numbers didn't come in great. Yet this morning, we get manufacturing numbers, and they beat. And it's like, wait, so which is it? And one of the things that I sort of tell myself is, okay, well, the more we have this sort of uncertainty, the more you know it's probably a time to invest. Because when you have that kind of uncertainty, when you have, quote, U.S. factory production increasing 0.8% Tuesday, double the 0.4% expectation, and standing in contrast to the Empire manufacturing data, when you have that kind of unclear data, it sends large signals, in my opinion, that, okay, you can't fault the market for freaking out. You can't fault the market for selling down or having these bear market rallies. I kind of feel like we're in like a really wavy ocean. And previously, we were on a flat ocean. And so we're sort of on our wave runner going to our destination, which is basically just like prices just going straight up. And so we're just on flat Florida water. Now we're in these crazy waves and people are tipping over and nobody's enjoying their time on their wave runner because it's like, you don't even know where the next wave's going to come from. You're getting sideswiped and all this mess. And to me, that's reiterated by sort of unclear data like this. But I'd rather be buying in a time where waters are not calm, whereas that's in contrast to buying when times are calm. That's actually when you're most at risk because you're not paying attention to those potential nasty rogue waves that could come and crush your valuations, right? So keep that in mind. Okay. Wow, this voice thing sucks. Oh, by the way, before I hit retail sales and Walmart and some of these other things, I do want to mention that I've got a ton of emails to go through. So if you are waiting for an email reply because you had questions about the bundle or bundling up courses, and you send an email to kevin@mekevin.com, I'm still going to honor the pricing. I'm going to get through these emails for y'all and make sure that you get taken care of. But it will probably still take another 24 hours. There are too many of you, but I will take care of it. It'd be a lot easier if I still had all the employees I had. But honestly, hey, if you're okay being patient, then I'm okay saving the money on the employees for now. Still want them, but oh well. So Walmart. All right, let's talk about this. Walmart comes in with price cuts, actually, on 10,000 items. They cut their profit forecast, and they missed on the bottom line. Now, they mentioned that they expect the second half not to be terribly different from their expectations, and that consumers are still spending on higher end goods. This is consistent with what we've seen with like MasterCard and Visa, even the banks, that people are still spending on expensive things, luxury goods, like in this case. And to me, when I read this, I'm like, oh, does that really seem like a luxury good? And then I remember back to my childhood, and I'm like, yep, when we were broke and going through foreclosure as a child, which had substantial scary memories for me, I couldn't buy the gaming console I wanted. I couldn't buy the patio furniture I wanted as a child. And so anyway, the statement here is many consumers are still spending strong on high-end goods like gaming consoles and patio furnitures. However, others are more focused on store brand jelly, lunch meat, and bacon. So you're seeing that lower end starting to feel that inflation bite, starting to compress a little bit. And Walmart who's obviously caters to a lower end customer, average income of a household there somewhere between 56,000 to 80,000, depending on which metric you look at. So catering to the lower end of the household incomes throughout our country. And so it's not a surprise to see price cuts, to start seeing some sales get pushed again. For example, a big place they're cutting prices is actually apparel, which kind of makes sense because I feel like when we started going out again last summer, everybody's like, all right, I need new clothes. And now everybody's like, all right, I got my new clothes. So kind of makes sense. And when we get the CPI data, we see the same kind of compression in clothing. So then retail sales. Let's talk briefly about this, then Home Depot. Retail sales came in at a 2% advance in restaurants and bars. That's after an already strong 1.9% last month gain. So people spending more, restaurants, bars. I agree. I'm one of those. Building materials down 0.1%. More evidence that the property market is cooling. 2.7% decline in gas spending as people potentially are driving slightly less under higher costs. Okay, this was shocking, okay? The March retail sales figures it came in at a negative 0.1%, so a contraction, right? And that is part of GDP. Well, now, and I know some of you, and like I can't like fault like maybe the 20% of you who are going to think this. They're going to be like, Biden rigged this. But apparently, the March figure has now been revised from negative 0.1% to a 1.1% gain. And that is part of GDP. So that could potentially, when we rejigger the GDP numbers, probably in July, mean we were not at negative GDP in Q1. These numbers, they feel so rigged. Anyway, retail sales up 0.9%. The estimate was 1%. So slight miss there, but honestly quite good because core, which was excluding autos and gas, was 1% rather than the 0.7% expected. Americans kept spending at a robust clip, relying on credit cards amid surging pricing we got. Walmart's seeing double-digit inflation in the food section. We do have 5 Fed speakers today, so you're going to have a lot of Fed speak today. You've got Home Depot. This was an interesting one. It takes a while for the real estate market to slow down, but I think you're starting to see some of the cracks, and you have to look really closely at Home Depot. The headline numbers won't actually help you. See, the average ticket at Home Depot was up 11.4%. Same-store sales were up 3%. However, transactions were down 8.4%. So people are paying more, but they're shopping less at Home Depot. This is somewhat expected, but they're still raising forecasts because they're still expecting people are still going to pay through this inflation. However, they've only got 3.8% sales growth, the smallest in 2 years, and it's well below that inflation. You know, if they matched inflation in terms of sales growth, they'd be like 8.5% year over year. Well, they're only at 3.8%. So they're not able to pass along all of the high prices, and they are losing. But they're still beating expectations. So now, this was an interesting one. It was out of the 38 OECD countries, households, according to The Economist, households across the OECD countries are still sitting on roughly $4 trillion of savings, worth about 8% of global GDP. Not global GDP, 8% of GDP of these countries. And this is money that was accumulated during the pandemic. And contrary, to what's commonly suggested, not all of that money is in the hands of the rich. In America, the bank accounts, this is the bank putting together the numbers, accounts that low-income families were still 65% richer or had more cash than at the end of last year compared to 2019. So in other words, end of 2021, people were still 65% richer than they were at the same time in 2019. Even poorer folks. This is kind of consistent with what we've seen, that consumers still have about 140% more purchasing power than they had in 2019. And so I think that's why we're still seeing these retail sales strong. The problem is this could potentially push the Fed into that mandating the recession, right? The recession mandate, where it's like, well, we got to get inflation down, so let's just force a recession. And when Jay Powell yesterday started talking about Paul Volcker, I'm like, oh crap. MasterCard starting to use facial recognition rather than contactless cards or phones for their credit cards in 5 supermarkets in Brazil. That seemed pretty cool. Break-even treasury yield on the 5-year rising a little bit. It's a little bit of an inflationary concern, 3.12%. Still down about 15% from its peak in March. 10-year treasury, 2.96. A quick update on Elon and Tesla. SpaceX is selling some shares. Well, Elon Musk is selling some shares over at SpaceX. It's believed that this is going to help Elon with his Twitter acquisition and take some pressure off of Tesla. And they're raising at about $125 billion valuation. A firm says that 81% of all transactions were from repeat users. No one business accounted for more than 10% of their revenue. And during recessions, they believe they get substantially more customers than not. We also believe paying over time without late fees and gotchas will be in greater demand during a downturn, they say. Wow. Well, there you go. I got some emails to respond to. If you haven't yet emailed me or you've emailed me and you're waiting, remember kevin@meetkevin.com, honor those bundle coupons for those of you who are asking about that. You can also get the bundles when you go to meetkevin.teachable.com or use that link down below. And folks, thanks so much for being here. We'll see you in the next one. Bye.